From snowy New York City for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. So we've had a little bit of a shakedown on the CPI, and it has ripped the underbelly on the upside of these equity markets, with the breadth taking the hit down 3.2%. The countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, that CPI print coming in hotter than expected. What does it mean? Sends equity futures lower, Treasury yields higher. Traders continue to cut back their rate cut expectations. We begin with the issue of the day, inflation prints in the USA.
Obviously, it's not good news. We would have preferred to have seen something a little bit less than that. The Fed is much more focused on the PCE deflator than the CPI. Weights are different in that. They think it's a better measure of inflation. And by that measure, inflation is lower than what we see in the CPI. The Fed is not going to make a decision based on one data point. They're going to take the totality of the data, and they're going to look at it when they make a decision. Now, is a rate cut going to happen in March? Knowing what I know right now, probably not.
Those rate cuts keep getting pushed to the longer grass. Let's get to Mike McKee. Mike, your takeaway on this, it is all about not getting a sub-3 print. Give us your interpretation.
Yeah, there was still progress being made, Manus, but it's not the kind of progress that Jay Powell said he's looking for. Instead of a broad-based decline in prices, or at least in the rate of inflation, what we saw are some big categories that pushed it up. And as you can see, headline inflation up 0.3, core up 0.4, both a tick higher than anticipated. And that headline does not come down under 3% as people had hoped. Housing, rent, and food, both, or all three rather, were basically much higher than anticipated. Housing and rent come in up 0.6. Food doubled, up 0.4 from 0.2 in the month of December. So overall, that is not good news. We did get a big drop in gasoline prices and used cars and apparel as anticipated, but it's not enough to offset what we saw. And you can see the impact of what's been going on when you look at our ECAN function on the Bloomberg, and you can see how much more services contributed this month to the overall inflation levels. And the blue there is food much bigger than it has been in previous months. So that's going to be the thing that the Fed is looking at, taking this all apart to see where the inflation still is. And unfortunately, it's in the areas that they can't necessarily do so much about. You were right, Manus, though, about one thing, and that is we have pushed out the odds of a rate cut. Now, the markets don't think we will have a rate cut until June. It was anticipated for March, and then, of course, we pushed that out to the May meeting. And after this CPI report, it is now June, and we're down to 4 rate cuts this year from 6. So the market's starting to move towards the Fed's position. And at this point, I don't think you can really pick a date for a rate cut. There's still too much in flux.
Yep, the market is certainly readjusting live, and as we speak, that spike in the 2 years, and indeed, the betting now is that we move further into the back half of the year for rate cuts. Mike, thank you very much. Mike McKee bringing us the data. Let's take the conversation to PGIM's Robert Tipp and PIMCO's Aaron Brown. So here we are. I look at the data. The Fed may well be disappointed that the core number on the headline is not sub-3, but they're going to probably welcome the fact that the market has been brought to heel. 4 rate cuts. Pre-Christmas, we were at 7. Here we are at 4, and only a 40% chance of a 5th one. Robert, do you think that they'll welcome the shift in the market, but be wary of this respike?
Well, I think the Fed has had the right narrative, and the market has at times the wrong narrative. The market was looking for a return to secular stagnation, had a 3.6 Fed funds rate for January of next year priced in, way ahead of the Fed's 4.6%. I mean, that appears to be the market's de facto habitat mindset, that we're going to go back to target inflation, soft growth. But the Fed is monitoring the reality, and the growth is really solid. The inflation is more of a last mile phenomena, where that last mile of getting down to target after rapid deceleration is proving to be a little bit chewy. And so the Fed's dot of 4.6%, the market has not even quite come back to where the Fed has expected to be. So I think that's why the market is adjusting. I think the Fed, they would like to see a better number, but it's not a terrible number.
Okay, I like your take. It's getting a little bit chilly. Aaron, good morning. Good to see you. So here we are. You know, how disruptive is this spike in inflation? I mean, if you listen to David Kelly just before we came on air, it was about the auto insurance and it was about the shelter component that caused these real underbelly of the spike.
So I do think that this does complicate the messaging and the decision making for the Fed. Remember, as recently as a week ago, a number of Fed speakers pushed back on the market's expectation for Fed cuts, and were really guiding the market to more of 3 rate cuts this year, you know, maybe a little bit more than that, not what the market had been expecting, which was elevated relative to the Fed's expectation. So I think that the Fed has been trying to guide the market narrative to expecting less this year, but the market still, I think, was ahead of itself in terms of pricing, not just across bond markets, but across equity markets as well. You saw last week that some of the most beaten up, highest short interest names, you know, rallied pretty strongly last week on the expectation that we had good growth, but that the Fed was still going to have this very dovish narrative. And I think you're going to see that come out of markets this week, you know, certainly following this print and unwind. And so I think some of the market movements that you're seeing today is just an unwinding and disruption of this very soft landing theme that's a narrative in the market.
Yeah, I mean, one could say it's a moderate interruption or perhaps just a reality check. The red headline is that the swaps market has shifted to July from June for the first full cut. Robert, this plays to your narrative, which is a slow go rate cutting cycle. If it's slow going and perhaps now in the camp of 3 to 4 rate cuts, and that's assuming that the market overreaches now to the downside, which is to take us to the level of the dot plot, what does that do to risk?
Sure. Well, obviously, this wide fluctuation where the market wants to expect the Fed will be, you know, cutting more aggressively into the 3s, but the reality is that they're cutting into the high 4s, you know, creates like a ping pong phenomena where, to the extent that the data, one print, you know, aggressively, you know, supports one end of the spectrum, where you could ping pong back and forth. But I think, you know, generally speaking, big picture, when you look at the huge swings that we've had with interest rates going from a 0.5% 10-year all the way up to 5%, we're in a relatively range-bound situation. So I think we are going to have volatility. It's going to be more intermittent. It's not going to be a major systemic shift in overall levels of markets here.
Aaron, this plays to your theory, late and less, but I'm drawn to the extrapolation that you make, which is they may be late and less, but then when they come, it's like all good things in life. It'll last longer. It'll be deeper than the market currently expects. So how late will they be? And then how deep do they have to go? Because that says to me that maybe they have to cut more for all the wrong reasons rather than disinflation. It's more about a slowdown. But is that over-extrapolating your thesis?
No, I don't think so. I mean, the higher for longer theme or thesis really does mean that it does create more risk of a recession, or at least of a more pronounced economic slowdown, the longer that rates remain high. And so that certainly is the risk. And I think that the market has sort of priced out that tail of a recession. And I think that that's probably misplaced. And so we do have to be cognizant that you are seeing pretty big divergences right now in the real economy, as well as in equity markets, in terms of how the large caps that have ample liquidity, easy access to capital, can issue in the bond markets, can issue in the equity markets, are doing really well. But the small caps are not doing as well. And this is reflective of the general economy as well, as where there's a big divergence between the haves and the have-nots in the market. And so the question is what's really driving, you know, equity markets and what's driving the economy. So I do think that as we, you know, push out rate cuts rather, and as we, you know, persist at this higher rate, those companies that are, you know, the most vulnerable and need capital the most are going to come under increasing pressure.
Do you think, just to continue that thought process then, Aaron, do you think that we're going to see more injuries like the regional bank disruptive moment that we had a couple of weeks ago? Are there going to be other small canaries in the broader minefield?
So I do, and I think that that's one of the big risks out there for the market. I don't think that these are going to present systemic risks and take the entire market down, but I do think that you're going to see these intermittent periods of disruption, not just from other regional banks, but from other sort of small cap sectors that are highly leveraged, that have really depended on the last decade of liquidity and now have rolling maturities that they're going to have difficulty refunding. And so there will be casualties along the way, and I think the most distressed parts of the market are going to be sort of the epicenter of those casualties, which is why in our portfolio we have a real up in quality bias right now in terms of how we're positioning across credit and equity markets.
Robert, this is a salutary reminder to anybody out there that goes back and looks at the follies of cutting 1986, 1987, and then, of course, you had the LTCM. So we have this lovely bond piece out that, traders should be wary that the Fed may well have to raise rates after they initially cut them. Do you subscribe in any way to that thesis? Do you think it is right to look back at 1986, 1987, to look at the LTCM crisis of 1998? Do you think that has merit, or is this just such a different economy?
Well, I think this is a mid-90s kind of environment, which is very positive. The Fed hiked from 3% to 6% between February 94 and January 1995. And then they cut rates in 1995. They raised once in 97. They cut in 98. They raised in 99. But they were all small 75 basis point or less cycles of fine tuning. And I think that is a big positive ultimately for the bond market and for credit product here. I think for investors that lock into pretty high yields at this point where central banks are done raising rates, they're going to reap the benefit of that. And the fact that rates are high and that the Fed is going to be very slow to cut, since they think the neutral rate may have risen, is going to afford them the latitude to cut if they need to avoid a recession. And that's one of the problems that we had back in the secular stagnation era. They were running so close to the effective lower bound that they had to resort towards their least effective non-standard measures once they reach the effective lower bound to accommodate. Now they're going to be up at a high level of rates. We have a shortage of housing. They should be able to easily cut rates a bit at some point and stimulate growth. So I think it's going to ultimately be a big positive for the economy and help people to earn these high yields.
Well, they have got the bullets in the gun, so to speak, if and when there is an incident where they need to react in a timely and even aggressive fashion. So with that in mind, we'll square that away for now. Robert, stay with me. Aaron, stay with me. Robert Tipp, Aaron Brown, my guest this morning on the CPI, the hot print out of the CPI. Let's look at the repercussion under the hood of these equity markets. Abigail Doolittle is with me. So a broad sell-off, Abby, but tell me a little bit more about the nuance.
Indeed, it is very severe. And first, I would like to point out some of that broad sell-off only because it's pretty extreme. For the Russell 2000 futures, we're looking at the worst day potentially since September of 2022. For the S&P 500 and the NASDAQ, both down close to 2%. It's the worst day of the month. But that Russell 2000 down 3.5%, dragging on the bigger indexes. Though, take a look at ARM Holdings. After a massive rally, investors rethinking that, down 13.7%, having to do with the reality of their AI chip. From a technical perspective, this consolidation is healthy, and some of the rally may in fact hold. But today, certainly weakness on that CPI print, taking away some of those animal spirits in that risk-off mood. Doing the same for Advanced Micro, another AI chip company. Take a look at Microsoft, big tech, down 2.4%, because, of course, the idea that they won't be cutting potentially, the Fed, until July, that means that liquidity is still not as abundant as maybe investors would like. That puts the spotlight on valuation. And even for banks, Bank of America, down 1.7%. Not a lot of places to hide today, Manus, except for some of those idiosyncratic earnings stories that we will, of course, be taking a look at.
Indeed. Abigail, thank you very much. And just look at that ARM pre-market up roaring through last night and giving it back this morning. OK, coming up, investors are parsing these earnings for insights on, you got it, the U.S. consumer.
Narrow leadership, even if it continues, it's not a healthy thing. It's making the S&P 500 and growth indices very, very concentrated.
If you take a look at the heavy hitters who reported before the bell. That's next on Bloomberg.
narrow leadership, even if it continues, it's not a healthy thing, is still, after all this time, a tale of two cities where the mega cap tech companies are really the ones beating the earnings expectations, getting richer and richer valuations, leading the market higher and higher. It's making the S&P 500 and growth indices very, very concentrated.
Perennial conundrum for everybody, the breadth of leadership. It is earnings season. We march on. And the latest results provide insight into the U.S. consumer and how corporate America is dealing with the lingering pricing pressures. Shopify earnings missing the mark, warning that higher costs could continue to eat into the profits, sending their shares lower by 13%. Also, that hotter than expected CPI number this morning could disrupt all the betting, and it has disrupted all the betting on when the first rate cut will come. Abby, run me through your first take.
Well, you know, in terms of this hot CPI print, that is obviously creating a risk-off mood for investors, really a sudden halting of the rally that we've seen relative to especially the mega cap stocks. But we've seen some broadening, but now we're not seeing it in earnings results because it's not just DWS and David Bianco there who is a little bit concerned about the breadth of earnings. Bernstein's also saying that relative to the consumer, the all-important consumer, 2/3 of the economy, that they've come in a little bit light, too, in terms of some of those earnings that been a mixed bag. That's certainly true this morning, with the exception of Coca-Cola. They, of course, put up a good quarter. Some of the other consumer stocks that we have coming out this morning in terms of earnings, not so good. So for Coca-Cola, their organic revenue view was higher relative to the street. The volume versus price mix was good. Shopify, though, that e-commerce story, so not true staples, but certainly a consumer-based company in an indirect way. Their fourth quarter results came in better than expected, but after a 90% rally, the margin guide is really worrisome to some folks, suggesting that the pricing power is there. A real consumer tell, Marriott. So this stock is down. They did beat adjusted earnings by 68% to speak of pricing power and margin power, but they missed fourth quarter sales by 2%. There's a soft guide. And then finally, if we put it together with Hasbro, that stock is down after being down significantly over the last year. The demand for toys just not coming in. It's weakening. Sales missed. The earnings were missed by 41%, soft annual outlook. So I think that now maybe, Manus, in terms of all of these results of both big tech and some of these broader companies and this CPI print, maybe the idea of no landing, that's out of discussion. Yeah. Certainly we're back to the soft landing. And then is it that hard or rough landing? Is that going to be back into the equation? Let's stay tuned.
Yep, maybe I'll get a Marriott hotel room at a reasonable price. Abigail, thank you very much. Abigail Doolittle with the stocks on the move. Robert Tipp and Aaron Brown are my guests this morning. Aaron, just in the break, the three of us were just having those sort of squash moments of conversation. I'm drawn to your comment, which is, well, you know what? Unprofitable tech got a little bit of a wake-up call. You get this adjustment in rates, and it's quite a spiky adjustment in the short end of the curve. But maybe it's not such a bad reminder and creates pockets of opportunity. If you're not in on the Mag 7, if you're not in on those bigger beast trades, maybe this drawdown is actually just a bit of air coming out of the tires, and it's not that bad to have unprofitable tech take a smack.
No, I think that's right. I mean, I think particularly last week, we saw names get really ahead of itself. And actually, that was a continuation of what we saw in the fourth quarter of last year as well, where some of the more heavily short interest, more value-oriented stocks did quite well coming into the close of last year, continued a little bit into last week as well. And you saw these huge moves in stocks that probably did not have that fundamental underpinning for the types of advancements that we saw. When you look at earnings seasons this quarter, it really is this divergence between the tech plus sector, which has had delivered earnings, upwards of 38%, and the rest of the S&P 500, which has very middling returns. In fact, the cyclicals in aggregate delivered earnings year on year down 9%. A lot of that is being driven by the energy sector, but even stepping back from that, revenues across the board were relatively weak. The more service-oriented sectors did a little bit better outside of healthcare, but you're still seeing this market where you have one sector like the tech sector, which is up 40%, and you have another sector like healthcare, which delivered earnings down 20%. It's a huge bifurcation in the market right now, and I think that really presents a lot of opportunity for equity investors.
Can I just tell you this? You know how to see the top of a market. Today, technically, I'm deploying the rest of my pension fund from the Middle East into US U.S. equity markets. That's how you both know this is actually a near-term top. This is the most single devoted contrarian indicator to any investor out there at the moment. Let's just put that in. I don't know what portion goes into credit. I don't have anything to do with the allocation. But Robert, this must be one of those moments. You look at those credit spreads; they were squeezed so beautifully, weren't they? Is this a reminder that tech can, that credit could be in for a little bit of a shuffle and maybe a backup in yield in the spreads?
Yeah, I mean, honestly, that's the least of my concerns if I was looking at the markets from a macro perspective. Yields, even after the decline, are back up at pre-financial crisis levels. Whether you're looking at single B high yield, whether you're looking at the overall aggregate index, you've really revalued. Your real yields are at an attractive level. By contrast, equities, they're, I mean, in their worst quintile of valuations over that period. So you've seen a tremendous revaluation between the two. People can make the case that cash yields are quite high here, but those may prove to be transient as the rate cuts eventually kick in. So, you know, it's been a tough slog during the secular stagnation of where fixed income had a big pickup to cash, but it wasn't attractive to equities. Now I think those valuations on a relative basis have switched in a big way in favor of bonds.
Okay. Well,
despite the credit spread tightening. Yeah.
Okay. Well, they are mighty tight. Maybe it is the backup in yield is the opportunity to load up there. Team, thank you very much. Robert Tipp, Aaron Brown on the markets. Coming up, your morning calls, and we've had that hotter CPI print. BlackRock's Jean Bovin joins me after the opening bell, I should say. What it means for markets. What's he worried about? Good morning from a snowy New York. Equity traders don't have much to applaud about today because for now it's about an interruption in the projection of the inflation, the disinflation narrative, and that no landing gets pushed further into the long grass. Equities take a little bit of a touch on the downside. It is about the Russell 2000 taking the biggest dip of all, down 3.2%. There is the opening bell. Equities are lower. There's narrative here which is pushing rate cuts further out into July now. If you just think, as Abigail was saying to me during the break, we started in March rate cuts just a few weeks ago. We're now down to July and a 40% possibility of a fifth rate cut. So 4 cuts now priced in. That emboldens the dollar. It causes the euro to drop by 0.5%. 10-year yields are up by 8 basis points. The short end of the curve is where the monster moves are by 11 basis points. So a slight flattening there. And oil up by over 1%. The OPEC Secretary General, Haytham El-Gaith, says that its peak demand looks very far out. They see robust demand in China. They see very robust demand in China and phenomenal economic growth in India, according to El-Gaith. Okay, let's talk about stocks under the hood. JetBlue, the activist investor Carl Icahn revealing his stake of just under 10%, with the plans to seek at least one spot on the board. What are the implications, Carl Icahn, on your board in the airline industry? Abby, what have we got?
Well, it probably has some people quaking, but for stock investors, they're really liking it. We're looking at the best day for JetBlue, a bright spot on this rough tape day so far in that hot CPI print. We're looking at the best day in about 2 months. And this, of course, as Carl Icahn does announce, that legendary investor, a 9.1% stake, plus what you were talking about, eyeing a seat on the board. He's really looking, apparently, to boost shareholder value in the wake of the nearly collapsed deal with Spirit Airlines. Now, their position is just above $200 billion. That's the third largest for the carrier. So this is a significant position and reason to think that there could be some big influence here, putting pressure on CEO the new CEO, I should say, Joanna Garrity, who will be evaluating steps to return to profitability as a standalone carrier. But that's not the only bright spot in the travel space, Manus. We also have TripAdvisor, also related to a potential deal. And this stock is up more than 10% right now, up about 12%. This, as they have announced a special formation to consider deals, a special committee to consider deals. Now, Cowen does not see Booking.com, Airbnb, or Expedia as potential bidders. They're saying from a sum of the parts position, it would be a $25 stock. That's right around where the stock is. Another analyst over at Jefferies wants to know if these talks are already happening or if they're going to be new. Relative to both of these stocks into today, JetBlue had been down 28% over the last year. TripAdvisor down a little less, down about 8%. So today we have a balancing of the scales for these travel-related stocks.
We have indeed. And Marriott, of course, as you told me earlier, had a little bit of a touch lighter. Abby, thank you very much. Let's turn to the semiconductor industry. Shares in ARM Holdings moving lower. That's after a 4-day run that sent the stock to a record, a closing high. Ed Low is with me. And yesterday was pretty stunning for ARM, wasn't it? Up 29% yesterday. So what changes this morning? Is it just a little bit of exhaustion? Ed, good morning.
Yeah, good morning. A little bit of exhaustion, an assessment of the risk you're willing to take on a stock where the rally has driven it to a place where it's trading at 40 times forward 12-month revenue projections. Since Wednesday after market, when ARM reported earnings, the 3-day rally added a 93% gain to the stock, or in other words, it added one PayPal's worth of market cap to its value. We are down 10% now on the stock, trimming some of those gains. The question for the street is, even if you're bullish, how much further can this run? And there is a misunderstanding in the marketplace about what ARM is. ARM is not an AI chip maker. It is a chip design firm that has two parts to its business. A royalties-based business where it charges a royalty or commission if a company has used its blueprints or design blocks for a semiconductor, and it has a licensing business as well related to the underlying code that allows a semiconductor to communicate with the software that's intended to run through it. It does not make AI accelerators, which are the high-performance GPUs NVIDIA and AMD kind of dominate the market for. But the AI story is clearly there. So when you look at the revenue projection for the current period that has the street really excited, it is that licensing growth that is pushing the needle here. And what they're experiencing is the broader impact of AI infrastructure investment. The other chips away from AI accelerators that go into building out server farms and data centers. The one thing I reflect on is when I spoke to ARM's CEO, Rene Haas, on Thursday, he told me that this is in no way an AI hype cycle. This is real. How real it is, though, in terms of their top and bottom line growth, that's the assessment the street's making this morning as that sizzling rally halts.
Well, it is stratospheric, isn't it? I mean, tripling since the IPO. And I like the differentiation that you make in terms of the CapEx, which is intellectual CapEx, perhaps rather than industrial CapEx, where they have the exposure. Thank you very much. Let's turn on to the rest of the earnings. Coca-Cola reporting better than expected results, back off higher prices. Isabel Lee joins me now. Everybody in this sector being able to get away with raising prices, but they haven't been able to get away unscathed in doing so, Isabel, have they?
That's the thing. This is a story of how much Coca-Cola can still increase prices, because basically the story of the quarter was how higher prices help Coca-Cola overcome a volume decline, especially in North America. We have the beverage giant forecasting organic growth revenue of 6% to 7%. That's above estimates. So we also have Coca-Cola reporting fourth quarter organic growth of around 12%, which is also above estimates. So this was boosted by the likes of Mexico and Germany. Growth there was good, but not in North America. And Coca-Cola said that the increase in prices was 9% in the fourth quarter, which is more than what analysts expected. So pair that, Manos, with Coca-Cola reporting a volume increase of only 2%. So that also fell short of analysts' estimate. North America case volume declined by 1%. And last week we had PepsiCo reporting also the same thing. They saw a decline in North America, but to them it's around 6%. So to your point, how much more can companies keep on increasing prices without driving customers away? We have analysts saying that PepsiCo and Coca-Cola have to do better when it comes to their case volumes. And ahead, we have Coke anticipating a 4% headwind when it comes to their currency exchange rates, when it comes to comparable revenue. And also ahead, we have Coca-Cola releasing a new permanent flavor, and that's called Coca-Cola Spice. It's a raspberry flavor drink, Manis. Shares are up 1.5%.
There we go. Raspberry Coke. We've tried a couple of variations on Coca-Cola over the years. Isabel, thank you very much. Isabel Lee on Coca-Cola, stock up 1.34%. Now, Marriott topped their estimates in terms of the company benefits from increasing demand outside the USA. Alex Semenova is here to break down the details. The stock's down 5.5%. Why? Is it because of the outlook? Where's the weakness?
Yeah, very interesting here, Manus. Despite this reaction, a really solid report from Marriott with demand boosted by its international business, but that clearly wasn't enough to woo investors as revenue and its outlook fell short of Wall Street estimates. Shares were down as much as 4% in pre-market trading, even before that hot CPI print sent stocks down more broadly. Again, though, overall, the company did deliver on other metrics. Adjusted earnings per share came in at $3.57. That's above Wall Street's consensus estimate of $2.12. Revenue per available room increased by 7%. This is a key profitability metric for the company, and it increased 17% internationally, making up for slower growth in the U.S. And very interesting here, not only did it deliver on this metric, but Marriott's revenue per available room in 2023 actually exceeded 2019's pre-pandemic levels. So you're asking yourself here, why this reaction? Well, Jefferies analysts sum it up very well. They say a generally solid report and guide is likely not enough to push shares higher based on the strong performance in recent months. And it did have a very strong run. Marriott shares were up 67% since the end of 2022. It is the best performer in a Bloomberg index of American lodging companies. Manus.
Alex, thank you very much. The very latest on Marriott. Well, BlackRock's Jean Bouvin writes this. We think the positive risk sentiment can run for a while as markets price in robust U.S. growth, cooling inflation, and Fed rate cuts. Yet, we still think elevated wage growth will push inflation back up before the end of the year. He joins me now. Good to have you with me, Jean. You look at this morning, the disruptors in the CPI at the moment are not the wages. It is the auto insurance and it is the shelter. So two of the portions of your narrative are perhaps challenged this morning. Inflation's not behaving as they possibly want, and those rate cuts are getting kicked further to the second half of the year. Good morning. Disrupted, interrupted, mildly bothered?
Well, you know, I think this is a story with nuances, and we don't like nuances. So we think inflation is going to go to 2%. Right now, I mean, if you look under the hood, we're saying, like, as you say, this is a story about shelters mainly. Core inflation, ex-shelter, is running at 2% over the last 3 months, even with this release. So I think the story is still in the near term that we're going to see inflation trending down. The market is overreacting. That has been the story for the last 18 months. We've seen that in December with the shocker FOMC, massive rally, right? And now 6 cut expected in 2024. That was overextended. I think that's getting corrected as we speak. But I think the broader story will be one where inflation is going to continue to trend down over the next few months. We're going to see cuts. But as you say, and as you quoted from your quote here, is that the bigger story is that we think once we hit 2, we're going to then be on the path that is going to rebounding later this year. So that's a nuanced story where we see the market right now reacting to a print. I think it's going to be still a market that's going to be supported by a soft landing narrative over the next few months. The Fed will ultimately cut. That's going to be the story. And then later this year, then I think this is where our worries are really more about rather than now.
I mean, I'm always drawn to those emotional bond traders who perhaps overreact. That's the beauty about markets, overreaching on the upside in terms of equity prices and perhaps overselling on the downside on the bond prices, spiking the yields. With that in mind, when you see this backup in yields, 10, 12 basis points, I know it's not massive on the short end of the curve, but likewise, 10s are moving up by 8 to 10 basis points this morning. Do you think this just presents better opportunities to buy fixed income? Because I'm reminded by Mr. Kelly, who was on surveillance just before the end of the show, that really you buy bonds for income. And of course, it is about yield to maturity. So on these backups, Jean, is it just more appealing to step in incrementally?
Yeah, so we've been, very positive on short duration bonds. I think the income story is powerful. In a world where the Fed will not be cutting rates as much as the market expected, which has been our view all along, income is a durable story. So that continues to be the case. I think a day like this makes that case. However, when you think about longer-term bonds and 10-year yields, I mean, close to 10 basis points move, that's meaningful on a one data print. I think it speaks to the massive volatility that long-term bonds still, display. We're neutral. We're neutral on long-term bonds. I think we expect, on a year basis, long-term rates to be higher than they are right now.
How high? Do we retest 5%?
On a 5-year basis, I think we're going to retest 5%. That's in our capital market assumptions. But on a 1-year basis, we're going to get higher than we are now. I know,
But that's because you worry. You think that persistent inflation is one of the clearest challenges, and I suppose this then raises the question about a higher neutral rate in a higher inflationary environment. Are we moving into a different, I don't know what the right word is, paradigm, period of time, evolution of macroeconomics?
Yeah, I think our view for the last couple of years is we've entered a new regime. We're not going back to the great moderation that was prior to the pandemic. I think there are ongoing forces that will create ongoing inflationary pressures. Doesn't mean inflation will be out of control, but it's going to require a central bank to lean against this inflation more systematically. I don't want to get into a debate about the unobserved neutral rate, but whatever that is, I think central banks will need to stay above that rate in order to contain these inflationary pressures. And so that is kind of the broader environment we're in. I think it's going to manifest itself later in this year when inflation starts to appear to rebound. And I think we're going to see a decoupling between short-term rates at that point because they're not going to go higher. They won't be lower as much as market were expecting. But we're going to see a decoupling where I think long-term rates start to move up despite short-term rates being stable. And I think there's also a big debt story that is in the back burner right now, but is relevant to this long-term rate outlook.
It's interesting. We have this little bit of a bolt disruption in CPI. As you say, take out the shelter, and we are at the 2% level. But those other disruptors have come today. This is the Bank of America Fund Managers Survey. I mean, it's hellishly bullish. Long Magnificent Seven, short Chinese equities. But they talk about the survey being the most bullish in 2 years. And cash has now been cut to 4.2%. Now, I'm drawn to that because that says something to me about those money market funds and the money that was sitting on the sidelines and about deploying that. It's interesting. It's the first time that they've stopped predicting a global recession. I smell capitulation.
I think this is the story of the first part of this year. This is pretty powerful. This is the immaculate disinflation story playing out. It's going to take a while before it gets really challenged. I mean, a data like today is going to be temporarily testing it, but we're going to get other evidence that inflation is trending down. I think that's going to add to this bullish sentiment. People have been sitting on a lot of cash.
Yeah.
That's not the way to invest. At some point, you're not comfortable with this. So the temptation to deploy it in the first part of this year, I think, is pretty powerful and ultimately underpins this market.
Well, if I can be honest with you, I'm still stuck in the CD and I can't unwind it. Jean Pauvin, thank you very much. Not yet. Jean Pauvin there from BlackRock with his calls on the market coming up. You've had the disruptor of CPI hitting the tape this morning, coming in hotter than estimated. What will the Biden administration say about it?
We know prices are still too high because of what I call greedflation and shrinkflation. I'm calling on corporations to pass their savings on to consumers, for God's sake. We're making real progress.
Making progress, just not on auto insurance or on rents. It's a snowy day on this eastern seaboard and in the capital. Good morning from New York.
Some companies are trying to pull a fast one by shrinking the products little by little and hoping you won't notice. Give me a break. The American public is tired of being played for suckers. I'm calling on companies to put a stop to this.
Big call from the White House there. That was President Biden using the Super Bowl as his opportunity to hit back at those companies over, you got to shrinkflation. Now, meanwhile, the CPI print coming in hotter than anybody had expected, complicating the president's message. How does he sell this? A new Financial Times poll shows Americans trust Donald Trump over Biden to handle the U.S. economy. Joining me now is Amri Hordan. Amri, normally we have the statement from the White House. We just don't have that as yet. This is going to be a hard one to sell.
Well, it is. And we saw the president this week before the Super Bowl talking about shrinkflation, trying to put this blame on corporate America. We also saw him engage in this yesterday, talking about shrinkflation and greedflation, the reason why inflation is still high. So potentially he's going to lead on that, maybe deflect. But what you see in this CPI report has a lot of political landmines for this administration. The one shining light for them is the fact that gasoline prices are so depressed. But besides that, you're seeing groceries at home, dining out, shelter. All of this is higher. And at the same time, it's not going to help the president when the fact that he's saying people are feeling better at the economy when inflation and you have these kind of prices still rising. And what we see in poll after poll is that Americans still have a trust deficit with this administration when it comes to the economy. And they give his predecessor, who potentially is going to be most likely his rival in November, better scores.
Yep, it's certainly injurious in the polls at the moment. Anne-Marie Jourdain. As we get that statement from the White House, of course, we'll bring that to you. Anne-Marie, thank you very much. Sector price action for the day. Abigail Doolittle has been checking the prices since the open. Abby, what have we got?
So we're seeing something that we have not seen in quite some time. I don't think that this year, probably not since October, September, but we're looking at a pretty brutal day sector-wise. Not surprisingly, the S&P 500 down 1.4%. Just the worst day in about 2 weeks. But the worst sector, real estate, down 2.9%. This, of course, is yield surge on that hot CPI print. That's the worst day since September of last year. You can also see that most of the sectors down more than 1%. So the risk on tone is out of the markets. Those animal spirits gone right now on the idea that the Fed may not be cutting rates until July. A major repricing on the part of bond traders and liquidity. The best sector, healthcare, consumer staples, those are both defensive sectors, down about 0.6%. That actually makes this risk-off picture even more risk-off since those are down the least. As for the sell-off we're seeing for technology, well, it, of course, comes in the backdrop, Manus, of the big rally this year, even with today's move lower for those tech-related indexes. Take a look at the communication services index, up more than 10%, tech itself up more than 7%, and then chips up almost 7%. So this is a piece of why these stocks had been, I don't know if you would say that they were priced to perfection, but definitely ahead, investors ahead looking over their skis and now taking some of those chips back off the table.
Yep. Abby, thank you very much. Detailed analysis there. Coming up on the show, we'll set the agenda for the trading diary in just a moment on Bloomberg. Stock euphoria interrupted as we see a spike in short-term yields. The possibility of rate cuts gets pushed out to July. We were talking about March just a few weeks ago. As you can see, the breadth of America under pressure, down 3.3%. Rising short-term rates challenges the big tech narrative, with some of the Mag 7 under pressure, and the SPOs are down by 1.34%. Let me get you up to speed with your trading diary for the rest of the week. Wednesday, it is Fed Speak again with Austin Goolsbee, and Michael Barr. Thursday, retail sales. How strong is the consumer? Plus another round of initial jobless claims. That takes us through to Friday. We've got the Fed Speak coming through from San Francisco. Fed President Mary Daly. On the back of this CPI, what will the Fed Speak be? We then go through to PPI at the close of the week. Right now, you're looking at Tesla off by 1.3%, Palantir down by 3.5%. So this momentum is building on the downside. Bank of America, Microsoft off by equitable amounts over 2.4%. So this is a hot CPI print, just as the Bank of America Fund Managers Survey comes in as the most bullish in a couple of years. The challenges are obvious for the Fed in terms of a respike in inflation, but they'll probably welcome the fact we're down to 4 rate cuts for 2023, down from 7 a little bit earlier in the month. That's it for Countdown to the Open. This downdraft looks as if it may persist, a bit like the snow in New York. Persistent and a little bit mizzly for the rest of the day.